So it's really important that we remember that it's this idea of risk appetite and risk aversion that we're trying to get a grip on. And then also make sure that we're not just assuming that because the dollar's down that necessarily everything will fall into place as normal, because we don't want to rely on this consistency of these correlations. That would be neglecting the fact that things can move for their own reasons other than their relationship to one another. So, looking at the dollar index here, first thing that I notice is obviously the down candle that we're seeing right now. And I want to know where this is coming off of. Now, I look at this last high here, which was 80.43. And if I want to put that in specifically, that's fine. 80.43. And then the high we had here where it exhausted and sold off, that we're seeing right now, that high was 79.87. So, right off the bat, it's fairly clear to see that there are enough bears waiting around, not necessarily at 80. I mean, they're not at the 80 level. Let's just be clear about that. It's not that 80 is impenetrable in any way. It's simply that the proximity to 80 seems to be bringing on a lot of that bearish sentiment in this case. And before, it was more of a situation where the bulls could not hang on to the momentum north of 80. So 80 is not the level where everything's turning around. It's simply where we have to remember that the bears are going to be in this area waiting, and it's selling pressure. As we move down lower, I want to make sure that I understand this move within the context of the market trend, which is this an uptrend? Well, if I'm looking at my uptrend within the confines of its clarity readings, so the markup's clarity readings, and that's solely determined by the angle of the 34 EMA wave, do we have a 12 to 2 o'clock uptrend? Well, that I think we do have, because if I were to basically take a trend line and just kind of extend it in the direction of the middle line here, which is the 34 EMA close, the gray line is the 20 EMA simple, and here's the, 20 EMA, 20 period simple, and then we have the 200 period simple here in black. So if I were to extend out the middle line of the wave, the 34 period EMA at the close, the angle, if we were to take a clock angle, if I asked you what time that was, I'd say most of them would say 1:30, 2 o'clock, right? In terms of the time. So I have the mark up. Now the other questions then are the lines of the 34 EMA wave smooth? I think they're fairly smooth. It's a daily chart. It's kind of unusual to see an angle at 12 to 2 or 4 to 6 with lumpy wave angles on such a long-term time frame, but it happens. The lump you usually get is when prices are moving in a sideways chop. So the lines are smooth. I mean, here's what chop looks like back here. Are they established? Well, not really. We haven't been moving up at this angle for very long. And therefore, the third question, is it respected? Well, actually, usually when we have a trend that has not been moving up for very long or down for very long, when it's not established, it's unusual to have a test where we can recognize whether or not prices respected the support or resistance, in this case support, of the 34 EMA wave, which we do have right there. So we started getting that early trend turn, and we see that one wick right there nail the wave. So we actually might have what looks like a very quick bounce, which means prices are respecting the dynamic support of the 34 EMA wave. So in an odd combination, we have 2 out of 3 criteria. But anytime you don't have an established market trend, you are dealing with what could be a transitional market that could exhaust at recent or significant highs. So now the question is, if this is going to prove to be the continuation of the bullishness in the dollar, when we get to the wave, we're going to have to see support. Otherwise, prices will simply return into this very wide range and possibly chop around, giving us some sort of distribution market trend.